Today is the 28th of October 2020. My name is David Hickson, and in today's market update, I'm going to be discussing the 40-day cycle trough, which I believe is forming in the US markets. We'll be looking at the S&P 500, as we have been over the past many months now. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So here is the situation in the S&P 500. This is the default analysis that has been performed by Sentient Trader software. In other words, I have not influenced the analysis in any way. And I discussed this analysis in my previous market update, which was on the 15th of October, which was, I believe, this bar over here. So that was our previous market update. I spoke about this analysis in which the 20-week cycle trough potentially formed here in the third week of September, and we were looking at the 20-day cycle trough forming at about that time, which you can see has now been phased on this particular analysis in early October. And lying up ahead, we have the 40-day cycle trough, then we have the 80-day cycle trough, and off to the right, we have the 40-week cycle trough, which lies a bit further ahead in this analysis. It is likely to occur early next year. I also presented an alternate analysis in my previous market update, and that analysis is still very viable. Let's take a quick look at that and remind ourselves of what this analysis is telling us. This analysis has the 20-week cycle trough over here at the end of July, and I've discussed the potential positioning of that trough in several of these market updates since July, so you can go back and remind yourself about the details of that. As you can see, I have pinned that trough. That pin symbol means that I have influenced the analysis that Sentient Trader is performing in order to position that 20-week cycle trough there. But it results in a very good analysis, in my opinion, and I discussed the differences between these analyses in my previous market update video, so I would recommend that you go and take a look at that video if you haven't seen it already. The big difference with this analysis is that the cycles are generally running much shorter. If you look at the recent wavelength of each of the cycles, which is on the right hand side of the chart over here, you will see that they are shorter than the average wavelengths that we expect according to the nominal model that Hurst himself defined way back in 1970, a nominal model that still proves to be remarkably accurate when analyzing the stock markets, particularly the US stock market. You can see that according to this analysis, we are expecting the 40-day cycle trough next. So in fact, even though we're looking at two different analyses, the next thing that is going to happen in both of these analyses is the 40-day cycle trough. And so a 40-day cycle trough is certainly what we are expecting to form about now. And in this analysis, the 40-week cycle trough is occurring much earlier because the cycles have been running shorter, and that cycle trough is still expected in about the end of November. And so this analysis is a much more bearish analysis because, of course, we are expecting the market to move down into that 40-week cycle trough. In my opinion, this analysis is actually the more likely one. But that is purely my opinion, and I'm sure many analysts will differ in their opinion. And the previous analysis I showed you a moment ago with the 20-week cycle trough in the end of September is still a very viable analysis and one that we need to keep our eye on. In my previous market update video, I mentioned one way that we could tell which analysis was most probably forming in the markets. So let's take a look at that. I spoke about the way in which price would interact with the 20-day cycle FLD. So here is the 20-day cycle FLD. That's not it. There we go. This is the 20-day cycle FLD for the analysis that we're looking at here with the 80-day cycle trough towards the end of September. And as I mentioned in the previous market update video, which was recorded on this bar over here, if price crossed down clearly below the 20-day FLD, then in my opinion, that tipped the scales slightly in favor of this analysis with the 80-day cycle trough over here, because of the sequence of interactions that we track between price and the FLD line. The FLD line is the future line of demarcation. That's what the acronym stands for, and I speak about it in all of these videos, so I'm not going to go on about it too much here. But there is a very reliable sequence of interactions that occurs between price and that line. It's not, as a matter of interest, something that Hurst himself discussed ever. It's something that I have observed over the years of working with Hurst cycles, and so it's not pure Hurst cycles work, if you like. It's a bit of a derivation of what Hurst himself did. Nevertheless, we track a sequence of interactions starting with the 80-day cycle. When you're looking at a 20-day signal cycle, we call the 20-day cycle the signal cycle, and the 80-day cycle is in that case the sequence cycle. And so you get a sequence over a full 80-day cycle. The first interaction is the A category interaction, which is expected to achieve its target or fulfill its target and even exceed it to the upside, which as you know happened here. Around about the time of the 20-day cycle trough, we expect price to come back to the 20-day cycle FLD and find support there. That is what seemed to happen over here, and that sequence of interactions, that's actually two interactions where price moves towards the FLD in a B category interaction, finds support, and then moves away from the FLD in a C category interaction. The next interaction is, of course, a D category interaction, and that is where price is expected to come down below the FLD, and it should then achieve its target to the downside, which in fact, if you can actually calculate it by measuring the distance from the high price to the level of the crossing and generate a target to the downside. And that target was not quite reached on Thursday of last week, but it was reached on Monday. And at that point, that move is fulfilled. I mentioned at the end of the previous market update video that if price crossed cleanly below the 20-day FLD, it would tip the scales in favor of this analysis, because that would be what we would expect from a D category interaction. And in fact, you could have traded that short trade as price crossed down below the 20-day FLD if this was the analysis that you had confidence in. So price is then, of course, expected to come down to the 40-day cycle trough, which is over here. And that 40-day cycle trough is expected round about now. In fact, it was expected a few days ago. So let's speak about that 40-day cycle trough. First of all, let's measure the number of days that there have been since the 80-day cycle trough at the end of September. There have been 34 days. The average length of a 40-day cycle is 36 days. So if this is going to turn out to be an average length wave of the 40-day cycle, we would expect it to continue falling for another 2 days. However, as I've already pointed out in this particular analysis, the recent wavelength of all of the cycles has been shorter than the average wavelength. And if we look at the bottom right of the chart, you can see that this wavelength for the 40-day cycle has been 30.8 days, 31 days. So this 40-day cycle is now, or today, about 3 days overdue, which is not really very much. It's less than a 10% variation in cycle wavelength. And so now is a very good time for that 40-day cycle trough to form according to this analysis. There is something else to be said, however, which has to do with the fact that this target has been exceeded. There was the target at this level over here. I think the target was at pretty much exactly 3,400, and price has dropped below that now by about 75 points, as you can see. What does that mean? What happens when a target is exceeded? What it indicates is that there is some bearishness coming into this market. Now, is that unexpected? No, not at all, because you must bear in mind that the 40-day cycle trough according to this analysis, is expected in about a month's time. So this is the last 40-day cycle trough that will form before that 40-week cycle trough is expected to form. And what that means, of course, is that the 40-day cycle is moving downwards. It's applying a downwards pressure. The 20-week cycle is also applying a downwards pressure. And the 80-day cycle is in the process of turning down. It probably turned down early because of the bearish pressure of the other cycles. And so you have a downward pressure of those 4 cycles. Those are fairly powerful cycles if you think about the length of their wavelength. And so it's not a surprise that we are seeing some bearishness creeping into the markets. Is it possible? I received an interesting email asking whether it was possible that the 40-week cycle trough could have formed over here on last week's Thursday, and that the only bounce we got out of that 40-day cycle was the price action on Friday. It is just possible. If you have a look at the foot of the chart, I've been drawing over it, but you can see the circle and whiskers for the 40-day cycle trough. So it is possible, it was within range. It is a little unlikely that the market has already turned that bearish with only 1 day's bounce out of the 40-day cycle trough, but it is possible, and it is a little bit of a warning. We need to stay on our toes. I'm not feeling wonderfully bullish this market. I hope that is clear. It seems very likely that we are heading down into a 40-week cycle trough, and I do expect the 40-day cycle trough to form round about now. But the big message really is that the 40-week cycle trough lies ahead of us, and so bearishness is pretty much the tone of the day. However, there is something else worth pointing out, which is that the next interaction between price and the FLD is expected to be an E-category interaction. Now, an E-category interaction under normal circumstances will also achieve its target to the upside. So let's assume that price does bounce now or within the next few days and then rises up and crosses above the 20-day FLD. We could indeed expect a bit of a bounce before price moves down into this 40-week cycle trough. However, I said that under normal circumstances we would expect price to cross above the FLD, reach and achieve its target to the upside. But these are not very normal circumstances. If this analysis is correct, because of the fact that that 40-week cycle trough is looming, we're getting closer and closer to it, and as we get closer to the longer cycle trough, the bearish pressure on the market increases, and so we're not really looking at a very normal situation. Add to that the fact that there are elections in the US next week, and we are certainly not looking at a normal situation. So let's take a look at the other analysis that I started with and discuss what is happening in that analysis. I have already mentioned, let's zoom in here as well, that the next thing that we are expecting in this analysis is also the 40-day cycle trough. And so here it is. Let's have a look at the way in which price interacted with the 20-day FLD in this analysis. Here you can see price came down to the 20-day FLD on Monday of last week. It spent a few days hesitating at about the level of the 20-day FLD, very roughly, and then it dropped away again, indicating that we do have a pretty clean cross below this FLD, which, as I mentioned, tips the scales in favor of the other analysis. But it does indicate that what is probably happening here is the price is moving down into the 40-day cycle trough. Now, according to this analysis, the cycles are actually running fairly long. We can take a look at the wavelengths at the bottom right-hand side of the chart there, and you can see that the cycle wavelengths are fairly long at the moment, and therefore the 40-day cycle is in fact currently running or recently running at a wavelength of 46 days. So there have been 34 days, so we might have several more days, almost 12 more days, until the 40-day cycle trough actually forms in this market. We have this nest of lows at the foot of the chart indicating the range of time in which the 40-day cycle trough is expected. You can see that it is leaning over a little to the right, and in fact, if I erase that nest of lows there and draw that again, you can see what I mean by it leaning over. If I draw the lines between the circles, you can see that that nest of lows is leaning over to the right, which would seem to indicate that the shorter cycles, by which I mean cycles shorter than the 40-day cycle, have recently been running a little bit shorter than they have done recently. I hope that makes sense. And so that's why you get this kind of leaning over nest of lows. Nevertheless, price is definitely moving down into this 40-day cycle trough. And let's work out the target for that 40-day cycle trough. That target is a slightly different target because the level of the FLD is different. And before we point out where the target is, you might ask, why is the level of the FLD different? You must remember, the FLD, a very simple line, is simply the median price, the midpoint between the high price and the low price of every bar, displaced into the future by half of the current wavelength of the cycle upon which the FLD is based. And so if you have a different analysis, you will have calculated a different wavelength for your cycle, as I've already indicated, shown at the bottom right-hand corner of the chart. And so the cycles here are longer, and so the average wavelength of the 20-day cycle, which the 20-day cycle FLD is based upon, is of course different, and so the median price is displaced a different number of bars or a different amount of time into the future. And so we have a different crossing point, and that target was not quite reached on Monday. In fact, that target was about 33.50, I believe. You could probably calculate that for yourselves more accurately. And it was reached in overnight trading today. So I'm recording this video pretty much as the markets open in the US. And so this red bar that you see here is what happened in overnight trading. And so according to this analysis, we have only just fulfilled the target from this price cross, which is also, of course, a D interaction price cross. And we would then expect price to bounce up again, cross over the level of the FLDs I've mentioned, and achieve its target to the upside. Now, this analysis looks good. I mentioned the bearishness that was creeping into the market in the other analysis, but in fact, that same bearishness isn't evident in this analysis. And even though the past 3 days have been fairly bearish, all that has happened so far is that the target has been achieved. It's been ever so slightly exceeded, but we're not seeing any bearishness yet. So we have another very interesting moment in the markets. If that bearishness continues to weigh the markets down, then again, I am going to continue to favor the other analysis, which I should point out is still my preferred analysis. If, however, markets bounce back up again fairly promptly from roughly the current level, then this analysis will certainly still be in play, and we'll be looking at price crossing above the 20-day FLD, achieving its target to the upside, and the bearishness will not be as apparent. So let's just zoom out again, and I'd like to show you one final thing to wrap up this video, and that is the composite model line. Now, the composite model line is simply another way of understanding the implications of the analysis at the foot of the chart. I often get emails and questions about the composite model line because in some ways it is a projection, but it's not, strictly speaking, an accurate projection of what we're expecting to happen. What it is it is a deconstruction of all the analysis information that we have at the foot of the chart, and then that analysis information in terms of the cycle wavelengths and the amplitudes of the cycles is recomposed to form this line. That's why it's called a composite model line. And in the past, it shows us what price action would have been if the only thing influencing that price action had been the cycles that we have at the foot of the chart, which are all these diamonds, of course. So that is what would have happened in the past. And then all the composite model line does is it extends that information into the future. Now, that's not really a very accurate projection. All it's telling us is what we should expect, or what the implications of this analysis are. And the implications are clear, that in fact the market has not turned bearish yet, as I pointed out a moment ago, according to this analysis, that we are next expecting price to bounce out of the 40-day cycle trough. It might indeed achieve a new high, and then it's going to turn down at a later point and move down towards the 40-week cycle trough. But now this is not my preferred analysis, as I've mentioned, and so let's take a look at the composite model line on the analysis that I think is a little more likely at the moment. Here it is, and let's turn off that FLD, turn on the composite model line, and here we get a very different composite model line. In the past, there's not much to distinguish between the two of them, which indicates that both of them are fairly accurate analyses of what has happened in the past. But there's a very big difference in terms of what's going to happen now. As you can see, we have only a very small bounce out of the 40-day cycle trough. Why is that? It's because of the bearish pressure of the longer cycles, as I've already mentioned, and so we are seeing the next sort of big-ish move that's going to happen, a move down into the 40-week cycle trough over here. Now, I'll show you one final thing on this analysis, which I think is really quite interesting, and it is, again, the FLD. I'm going to show you two different FLDs, the 20-week and the 40-week. And I'd like to point out something on this analysis, which is that following a trough of at least 54-month magnitude, which I believe the trough at the end of March was, the first time that price touches the 40-week cycle FLD, and this is a little test for you to see whether you have understood the concept of the interaction between price and the FLD. The first time that price is expected to touch that FLD should occur at the first 40-week cycle trough following the sequence cycle trough. Okay, so our signal cycle in this case is the 40-week cycle, and at the time that the 40-week cycle trough forms, we would expect, according to the way in which these FLD and price interactions work, we would expect price to find support at about the level of the 40-week FLD. We do not expect it to be very accurate support, because we're looking at a very long cycle, so we might need to be looking at this on a weekly chart as opposed to a daily chart. But nevertheless, we would expect price to find some support at the level of the 40-week FLD. I find it quite interesting that the composite model line, although it's not a very accurate projection line, it's quite interesting that it brings price down to about the level of the 40-week cycle FLD at about the time of the 40-week cycle trough. All of those different pieces of the puzzle are falling into place in terms of this analysis. The picture is not as good on the other analysis, but it increases my confidence in this particular analysis, and this is certainly the one that I'm going to be focusing on and watching carefully. One final comment. I don't want to make this video too long, but the price has done something interesting. For those of you who have studied the FLD trading strategy, you will know that I speak about something called the FLD bubble. The FLD bubble forms between the signal cycle and the cycle 1 degree shorter than the signal cycle. It forms between the FLDs, and there we have an FLD bubble. And what tends to happen as price drops into the B category interaction. So let's just label these here. Here's the A category interaction for price crossing the 40-week FLD. As price approaches the B category interaction, the first thing that happens is price drops into the bubble. Can you see the bubble? I've drawn it in that yellow pen over there. That's it there. I know it doesn't look very much like a bubble. Sorry about that, but it's a sort of a, it's a shape. And price drops into the bubble by dropping through the 20-week FLD, and we're entering the period of time in which it gets trapped in this bubble. It is expected to find support at the end of the bubble over here. Okay, so that is where we would expect the price to find some support. Don't take the level of the composite model line too seriously. As I've mentioned, it's more of a structural thing than an accurate projection, but certainly the level of the FLD, the 40-week FLD, is one to watch for the point at which the 40-week cycle trough should form. I do hope that you found this market update interesting. Let me know if you have any questions. Put them in the comments below the video. And take care out there in the markets. They are likely to be fairly volatile, of course, surrounding the US elections. So we need to be a little careful of that. And I look forward to seeing you in my next market update.